In company news, Investec share price climbed in both South Africa and the UK after the lender announced a record dividend for the third consecutive year. The specialist lender reported a 7.8% rise in adjusted operating profit to just over £1 billion, a first for the group, boosted by a 5% increase in revenue. Now, despite a slight dip in headline earnings per share, the final dividend came in ahead of analyst forecast at 36.5 pence. Meanwhile, Investec is targeting a 14% return on equity by the 2026 financial year. Investment analyst Itimbila Bupila weighs in on the results.
So Investec released full-year results for the year ended 31st of March 2025, which showed adjusted earnings per share, or EPS, rising 1.3%, which was in line with recent guidance. Revenue grew 5% year-on-year, and really the numbers highlighted a resilient performance from the group amid what has been a tough economic environment, with particular pressure in the UK market. There, for instance, we saw operating profit rising 1% versus South Africa rising 4.8%. Overall, though, top-line growth remained underpinned by continued loan book growth, which speaks to healthy credit demand, as well as strong fee income amid robust client flows into discretionary and annuity funds, and that's speaking specifically to the SA business. In terms of operating expenses, those remained well managed despite further business investments into staff and technology, resulting in positive jaws, which of course occurs when revenue development outpaces cost growth. And from that, we saw a further improvement in the cost-to-income ratio, which was indeed a highlight. Conversely, credit costs accelerated year-on-year against what was a softer base, reflecting higher specific impairments in the UK, again, greater macroeconomic challenges in that region versus SA during the year. But overall credit quality, so speaking to good repayments, lower default risk, those remain strong with no evidence of trend deterioration, which was also a positive takeaway. Management's outlook remains optimistic, with positive revenue momentum expected to persist into FY26, in spite of prevailing macroeconomic challenges and the negative impact of interest rate cuts on the group's, or rather in the group's core markets.